Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, January 3rd, 2025, our first episode of 2025, S&P 500 currently sitting at 5940. I'm David Zarling. I'm here with Ian McMillan. Took a week off for Christmas, Ian. This is our first episode in the new year. How was your Christmas?
It's very good, very relaxing. Big road trip up to Maryland to see Kate's side of the family. The kids got to see their cousins, which is super fun now. They're all they're all walking, so they're all pretty much troublemakers.
It's awesome.
But no, it was very good. What about yourself? I know we've had an interesting last few months.
Yeah, I appreciate that. It was a very special Christmas for our family as well. As you know, our family needs a savior, and so we follow Jesus, and one of the rewards of doing that is you get heaven, and Jesus saved us without anything we can do. And I'm happy to let people know that my dad now has his heavenly crown. He passed away on December 23rd, and I'm so excited for him to have the best Christmas ever. I will miss him dearly. He was a chief counselor of mine, a great mentor and a great leader, but these are the things that await us all. And so I'm just, happy for him that he gets to be with his savior, and we wait our turn as well. So I appreciate that, Ian. I don't want to spend an extraordinary amount of time on that topic because I don't know that our listeners want to see me get emotional. But the year of 2024 will always be remembered for a variety of reasons. One of those will be Dad in heaven. But I think it's also fair to say, if I can pivot it this way, a really nice year for markets.
Nice year for markets. First, before we go there, very, very beautifully said. But yes, 2024 also continuation of the bull market. I think there were signs very early on in 2024. I think it was early to mid-January. We broke above that 4,800 level. Just a great signal there. And we felt it would lead to continued strength. I don't know if it's going to be 10%, 20%, 40%, who knows, but we did feel like the trend would continue up, and it did. Back-to-back 20% years. I think is it the first time this century?
Yeah. I mean, that it, by all intents and purposes, back-to-back. When I look back in history, you're right. We haven't seen that in quite some time, to have back-to-back 20% years.
And it's fantastic. I want to say there was 4 straight years to end the 90s. We're using the S&P here.
Right.
Think 4 straight years. That's longest streak. I'll have to...
Well, we could do this real quick. 1995 was 33%, 20% in 96. 1997, 31%. 1998, 26%. And 1999, just shy, about 19%.
Five straight years.
Wow.
And that was the last time you had back 20% years.
Yeah, you got to go all the way back to...
Now, 2019, 29%, 2020, 16%, 2021, 26%. So a close one. Had we not missed out on 2020, which... it's only 4% away, we could have had a nice 3-year streak there. But nonetheless, something to be grateful for, right? As a market participant, you know that you did not get to pick your trend or direction or the volatility within said trend. You don't really get to pick anything. You just get to constantly adapt. So when you are given a nice, and I would say for all intents and purposes, 2024, a low volatility year. I think we had the big correction in July, and then that was kind of it.
Yeah.
And I don't even know if that was, I don't even know if that was 10%. It was, okay, barely. We'll call it 9.5%, 10%. So I mean, if that was your correction for the year, I got to say that's a low volatility year.
Oh, yeah. But that's a low volatility. When you only have one of those, and you can expect one. You can expect one 10% correction. It's not a guarantee. That's just the averages, if I may use that term. But to your point, very 2017-ish, not same degree, because I believe the biggest drawdown in 2017 was maybe less than 5%, which is kind of unheard of. But boy, did we get volatility after that, right? We did. 2018, 2020, 2022, you did have 3 20+% corrections in a matter of 4 or 5 years there. But to your point, yeah, you just enjoy it when uptrends are happening. It's like sailing. If the wind's at your back, enjoy it. You don't have to tack as hard in order to get somewhere. So you sit back, you shut up, and you enjoy it. And that's what we had for 2024. And does it continue? Right now, we can continue to see rising 200-day moving averages. We continue to see higher highs and higher lows. At the same time, we have important lines in the sand that we can look at to see when that thesis, right? Because we operate in thesis, if the hypothesis is that the market's going to continue higher, well, mathematically, it needs to go to higher prices.
It's the only way this works.
Yeah, I know. Again, not sexy, but it's just the way it is. And, for as good as stocks were, U.S. stocks specifically, in 2024, it wasn't positive in 2024? Treasuries.
Terrible.
Down 11%. So if you're sitting out there with a 60-40 portfolio, talk about putting an anchor on your boat.
I don't think we've owned long-term treasuries for clients in, 40 years.
Yeah, that's one of my favorite charts.
I mean,
when we stopped owning them.
I mean, it's shut. You can't do it. I don't care. Right. And then the whole argument's yield, but you can go, again, you heard us talk about this. It's not like all of our clients have a risk tolerance of 100% equities. Right. So, we're involved in fixed income, but it sure as heck isn't long duration U.S. treasuries.
Right. Perspective's sake, you had convertible bonds up about 9% plus their yield. You had your triple B credit up about 2.5 plus it's about 8% yield. You have T-bills now paying 4.5 to 5.5%. So there's places to be. Even more, if I can call it exotic, I don't know that it's exotic, but owning some Pacific floating rate up about 1%, but yielding about 9%. There's places to be, but to your point, treasuries, not so much.
Terrible. Zero surprise, right? This is a rising rate environment until it is not. On the flip side of treasuries going down, quite the development in the U.S. dollar.
Yeah.
So what is this all about?
Right. The dollar being up about 7% on the year, breaking above a level we've talked about using DXY, a trade-weighted dollar, breaking above 100, 101, something that's been in place. That level is where sellers have shown up since 2016. Now, for all intensive purposes, we'll see where we go, but the next logical level using DXY would be somewhere near 117. And I know you've done a great job highlighting here on the past. Is that good or bad? If we go to 117, is that good or bad?
You tell me. So you just said, and I wasn't aware of this, dollar up 7% in 2024. When we're talking about currencies, I think that's a pretty solid move. And it was not in a straight line.
No.
But yeah, that's one of those kind of lame textbook rule of thumbs that gets thrown around. Strong dollar, headwind for stocks. And now again, I guess it could have been maybe with a weak dollar, the S&P would have been up 35% last year. I don't know.
Right.
But it doesn't seem to be an issue. Even gold so we had dollar up 7%. Gold priced in dollars was up. It did better in stocks.
Right.
Gold did better than stocks slightly. I think gold's up 28% maybe.
Yeah. Like when you talk, that's a great point. how many textbooks talk about a strong dollar with strong gold? It's not typically what you hear in your economic theory. You would see weak dollar, strong gold, or strong dollar, weak gold. And then I know you highlighted as well, as good as gold did in dollars, just crushed it in other currencies. If you were in a different country and West, if this podcast was Japanese centric, like we were broadcasting out of Tokyo, and you were talking about equities versus gold, your Nikkei was up 18% last year. But if you price gold in yen, I'm guessing that was that was the place to be.
I bet it was up like 50%.
33.
Okay.
Now I'm using a simple gold futures divided by yen dollar. Maybe a better way to do that, but
no, I think that displays the point perfectly.
Yeah, it's about, you got about double. If you were a Japanese investor and you had to invest in yen, that trade worked out great. And it is interesting that gold was as strong. What do you think about that? Gold being as strong as U.S. equities, gold in dollars being as strong as U.S. equities, priced in dollars. What do you think about that? Because we've had that before, right?
Yeah, we've had that before. I know Ryan Gorman brought up. So the last time that gold, they're up together a lot, but the last time that gold outperformed S&P when both were up, it's 2007.
Yeah, you did some good homework on this. So 05, 06, 07, 09, 2010, 11, 12, 16, 17, 19, 20, and 2023.
And I guess now 2024.
And now 2024, all years where S&P and gold were positive. But Ryan's point is 2007 was the last time they were both positive, but gold was better. And the obvious implication there would be potentially that right? We're all familiar with, I think everybody's ears perk up when you say 2007, 2008 is my guess. Anybody listening to this knows the market history of the great financial crisis, the mortgage crisis, housing crisis of 2008 in the first part of 2009. So it's worth paying attention to. I mean, it's not like we just get to look at that and say, for sure, we're going to have a major correction, but it's worth saying if a correction unfolds, and the math will show us that, because we mentioned lines in the sand that we can be looking at plus a 200-day moving average, that if we do have a decent correction in 2025, A, we'll adapt to it, but B, oh, wasn't it interesting what happened in 2024 with gold and stocks? It's worth looking at, I think.
I think so too. I would not have guessed that. Like when I saw that, when you posted it, because we share, right? We share in our team chat, the three of us, interesting stuff that we see, usually charts or some type of data point, whether it's D-Chip or, all the different Zaccardi, all the different stuff that gets posted. That is, it'll never top price, but I do think I don't want to say it's interesting, like, oh, it's interesting, and then I place it next to the toilet for reading material. I mean, it's interesting. I think it should be in the back of your head and something to be aware of.
If it's environmental information.
Yeah.
It's kind of like seasonality, meaning you don't stay involved just based on seasonality. Use seasonality as an environmental indicator, and is price confirming or refuting that indicator. Same thing with this situation with gold and stocks from 2024. Same thing. For example, you're not all in cash right now just because of that, but you're aware of that in the background. Okay, there's a construction cone on the highway. Does that mean more coming? Like, are we about to have a slowdown here?
Well, and
we're going to have to tap the brakes.
Something that I would say I witnessed in I think for sure but I would say it kind of grew throughout the year, is the very literal takes on seasonality that get passed around. It'll say like, okay, on average since 1952, we know that December starts off weak and then usually bottoms around the middle of the month. I believe that is the correct data.
Right.
So this year it didn't. And we got this big, it's like the whole, what do we talk about when people quote the market's on average up 8% a year? Well, it's like never between like 5 and 11. It's always some kind of outlier-ish number.
It's definitely an average defined by extremes.
So then we get, oh gosh, we didn't bottom, stocks didn't stop going down on this December 16th. And then, I mean, we're back to, anyways, I feel like the social media conversation around seasonality, which I do think seasonality is important. I think there's a lot of really broad principles and things there. But again, we talk about averages, and then when it doesn't happen, people feel some type of way about it.
Right. Well, I think, speaking seasonally, there's the Santa Claus Rally period.
Yes.
Which is the last 5 trading days of the year, plus the first 2 of the next year. So we're now at that point today, meaning this is the final day of that Santa Claus Rally period. And it does have some significance going when we look back in time. Where are we at with that? Are we positive in that?
I think we're going to be negative. Even with today, let's say we were to close today, S&P's up 130 basis points. Futures. So it'd still be negative, basically, thanks to last week.
Yep. Is the party over then?
Well, we were negative Santa Claus Rally last year. Is that right?
Well, and I would add too that the more important is the January barometer, really just looking at how, I know Jeffrey Hirsch highlighted this. He's from Stock Traders Almanac and, does great follow-up work on the work of his late father. And as January goes, so goes the year is basically the message there. And that one has a little bit more statistical significance than the Santa Claus.
We're off to a good start 2 days in.
So it's like everything in markets. You can't take each data point in a vacuum. It's why we call it weight of evidence. You have to present all the evidence in the courtroom. Price is the final judge. And so if that is going to be a situation, well, we know that buyers have shown up on the S&P 500 at 58.65 in November, December, and now potentially here in January, that if we hold this 58.60, we'll call it level, well, that would be information confirming that buyers still have control of this market. Below that, do we have an intermediate correction on our hands? That's definitely possible that you have some type of corrective period, but it doesn't necessarily, even with that, you still have to clear 5,700. You'd still have to get below 5640. And then you have the 200-day moving average on the S&P currently sitting at 5560. So you have these construction cone markers on the side of the road that can kind of give us a heads up on, do buyers really still have control of this market? Right now they do. Until those levels are cleared to the downside, buyers have control.
I agree with that. I want the market to go. As much as everyone, but as much as anyone else. But December probably healthy. You look at a price chart and much rather go sideways than down. So I will take it.
For sure.
I will take it. The correction through time versus correction through price.
Yeah. Very true. S&P 500 hasn't gone anywhere for 2 months. So to your point, very nice consolidation if this holds, building out the auction process. When you look at small caps using Russell 2000 futures, right, we responded to a rising 200-day. You have important horizontal price levels where buyers have shown up since the beginning of October at the 2220 level. And then you have volume weighted average price from April of 2024, also marking that level that we're responding to. And so do small caps hold up here and you start to see breadth expand? Could be. I don't want to suggest that small cap performance is equal to breadth performance, but
helps.
It helps. Doesn't hurt. What else, Ian?
A lot more than the NASDAQ 100 going up.
Yeah, correct.
Crypto had a nice 2024.
Yeah.
The crypto related stocks, very strong. All the ETFs, Bitcoin still just like equities kind of consolidating up here, sitting around 98, 99,000. Found support multiple times over the last 6 or 7 weeks at 92,000. So holding in there for now.
Yeah.
Also, something that's held up, and hey, Bitcoins are priced in dollars.
Yep. Positive with a positive dollar. Worth paying attention to. And while international wasn't all that great, you do still have Argentina.
Argentina and Israel, pretty much your lone places outside of U.S. borders. Argentina, ARGT, back to likely all-time closing highs today. So they have felt very little of the equity weakness. I know DAX, German DAX was looking fine. Still looks fine. It's not an outperformer.
But it's still in an uptrend.
But it's in an uptrend.
It's correlated. It's kind of like the Dow Jones, it's correlated. And so you want to pay attention to it. And while it's not an outperformer, still holding up nicely. It's good.
Growth value, I would still say still in favor of growth. At least a large cap growth, large cap value.
When you even highlighted high beta versus low vol.
High beta versus low vol.
I talk about that a little bit.
I think it's an important relationship. Again, like we said, something to keep an eye on. I kind of put it up there with like high yield spreads. Just something to keep an eye on. It's a little weak, that July sell off. It's still really been recovering off of that correction in equities back from July into whenever it was, early August, Monday, August 5th. Yeah. I'd say it's fixed itself and looks to be on the mend and potentially heading higher.
And you have, sensitive areas or risk-taking areas like semiconductors, cruise lines, airlines.
Airlines look great. Cruise lines look great. A lot of stuff in discretionary. I think Kevin has the discretionary workbook now.
Enjoy that, Kevin.
And you look at XLY, right? I mean, I would say, and of course, a lot of the comments you'll get, well, it's Amazon or it's Tesla. From an XLY standpoint, I get that, but beneath the surface, there's a lot of pretty good stuff going on.
Well, in our equal weight consumer discretionary using RS, pulling back, it broke out to new highs and is pulled back to that level in a very controlled manner without RSI getting oversold, a momentum indicator getting oversold. And do we see broad discretionary do well from this point? Time will tell, but it's a healthy looking chart. It's a healthy looking study of supply and demand. That's for sure. Totally agree with that. It's not like we're sitting here talking about your risk off places getting all the play. I think it's fair to say that healthcare still looks a little bit rough.
Staples hit new relative lows again.
Yeah.
Materials probably moved into the top spot for worst sector right now. Jeez Louise.
True story. It just keeps heading lower.
Energy maybe some type of mean reversion here for energy. We'll see.
Yeah, we will see. What are we seeing on oil? That holding up? I know we don't want to be
big move back to $74. We were sitting at 67. So you've seen dollar go up, oil up about 10% in the last 3 weeks. Interesting. Yeah. Oil priced in dollars was my point.
Right.
So I don't know. It's an interesting development.
And it looks like you better buy your steak and put it in the freezer.
Cattle's getting expensive.
Yeah, cattle's ripping and roaring, moving higher.
Cocoa expensive.
Put your chocolates in the freezer too. Can only imagine what those things look like priced in yen.
Coffee, expensive. Yeah, look at that for cattle.
So there's definitely
gas was just back to 2-year highs.
Yep. The Widowmaker, natural gas.
All right. So then what? Oh, what should I feed my family this week? Rice. Rice is not rice is just hitting new lows.
You just give them pure sugar. You give them sugars down.
Rice, soybeans, lean hogs. So maybe pork.
Yeah, give them some pork.
We're going to start eating more pork.
For sure.
Oats.
That I would say you could just pour soybean oil on the rice, maybe add some sugar. Maybe that's good. Sounds terrible.
Orange juice is expensive.
Yeah.
Copper's cheap. Can't eat copper, though. Probably wouldn't be good.
No. But yeah, 2024 was the year of every major currency pair struggling versus the dollar strength, U.S. equity strength, but international, you had to be really selective on where you had any exposure. We highlighted Argentina. Some spots in commodities, gold which we talked about, silver along with it, but copper was, positive on the year, but nothing really to write home about. So we'll see what 2025 brings. I mean, do we continue to see a downtrend in treasuries? Probably makes sense just from a standpoint of trends tend to trend. And if we're in a new 40-year upcycle in rates, until the information changes, that's what we've got. And 60-40 portfolio, if you've got one, might want to pay attention to that.
I'm telling you, don't hold out.
Question.
Don't hold out for the lower mortgage.
That's right.
I don't think you want to play that game over the next decade.
Nope,
Don't.
not at all. And speaking of great 2024, I should highlight the supporter of this podcast, the Adaptive Select ETF, listed on the New York Stock Exchange under ticker ADPV, which helps investors access two of the most prevalent factors in markets, momentum and relative strength. Using proprietary identification methods, the Adaptive Select ETF attempts to own the strongest 25 large cap stocks when the market is in an uptrend. And since not all market environments are the same, Adaptive Select seeks to prevent extended declines by moving to short-term treasury bills and cash during long-term market downtrends. Investors can find out more, including how to invest in ADPV, by visiting adpvetf.com or calling 1-833-880-5200. Investing involves risk, including possible loss of principal. ADPV is distributed by Quasar Distributors, LLC.
Yeah, good for those guys.
Yes, real nice.
Momentum had a good 2024. Lots
Sure
of
did.
momentum funds did very well, beat the benchmark, beat the S&P. But a little birdie has told me that our sponsor may have been the best out of all those momentum funds. You'll have to go verify for yourself.
Well, that's it. That's interesting. You bring up. So you look at something like SPMO versus S&P. When you do that relationship, that's now breaking out to new highs.
Yep.
So is 2025 going to be a continuation of momentum? Very well could be.
That would be beautiful. You find no complaints from me.
Nope. And that's one of those factors that tends to persist and is one of the most prevalent factors in markets. We know that from different historical data sets and research papers that have been done, that trends and generating alpha through momentum is a factor that is viable, that can, it's kind of like understanding that you're in a forest because there's a bunch of trees. And when you have trends continuing to move higher and momentum continue to be prevalent, you're in an uptrend. And that's what we have on our hands. I'm sure 2025 will throw curveballs like every good market year does. It's not like markets move in a straight line, and there's always a once in 100-year event that happens once a year because markets operate that way.
I think
They
I
are
read,
that tail.
so to your point on momentum, I think I read, and I'm trying to find this. Here it is. So we talked about S&P it was up 20% in 2023, 2024. So the 10 worst performing S&P stocks in 2023 were also down in 2024.
Persistence.
So, persistence to the downside.
Mm-hmm.
Typically, just as equal as persistence to the upside. So you had Enphase, FMC, Dollar General, Moderna, Pfizer. I will keep my comments to myself on those two. Estee Lauder, Paycom, Albemarle, AES, and Etsy, all down 2 years in a row, with the broad market up, about 50% over the last 2 years?
Yep. Moderna's back to, on a relative basis versus S&P, back to where we were pre-COVID crash. So sad.
So sad.
No, I think that's a great point to bring up as far as how trends persist. And so is 2025 another period where trends persist? I can't tell you. I wish I could, because here's the truth. I don't know, but I do know that we can have a plan. We can adapt to different market environments using different important price levels that I highlighted already on this episode, that we can pay attention to these things. They can give us some clues on who's got control of this market, because in the end, it's about being on the right side of the trade. And if we see sellers take control of this market, invariably, it will lead to breaking those levels and breaking something like a 200-day moving average. But one thing I know is 2025 won't be the same as 2024. And I'm not talking about uptrend. I'm just talking about what does it look like between now and December 31st, 2025. And it always goes so fast.
So fast.
It's crazy. Here we are, January 3rd. And, before you know it, it'll be July 4th. We'll be celebrating independence. And then I feel like from that point to Christmas is just a blink.
It is.
I don't know. Maybe that's just my age, Ian. Maybe Connor has a different experience because he's younger. Maybe it feels like a really long time.
I wonder if it'll slow down for you. You got 2 out of the house now.
Right.
I wonder if it'll slow down at all once then it'll be too slow. Once you're empty, you and Emily are empty nesters, it'll be too slow and quiet.
Yeah, you're going to get real annoyed with me real fast. Like, does he alphabetize his memes? Like, how is he messaging
How does
me
he find
this
him so
much?
fast?
Yes. How does he do this? Why is he... Stop talking to me. Yeah, that's very possible. Well, Ian, love doing this podcast with you. It's a great start to 2025. Anything else you want to highlight for our listeners before we sign off?
No, just if you hear me sniffling, that's me wiping my crocodile tears for Moderna and Pfizer being down so massively off the highs. But enough, I don't know what hand we're going to be dealt, but we'll watch the trends as they unfold.
Yep, we will adapt. So appreciate Ian. Thanks for being on here. Next week, whether it's you and Kevin or we're on the following week, appreciate you. Thanks for the great 2024, and I'm excited for 2025. Thanks for everybody listening. Make sure you share it with your friends, your family. Give us a high ranking. That lets us know that what we're providing to you is valuable. Thanks, everybody.
Have a great weekend, everyone.